So how does a major defense contractor make significantly less profit on the actual hardware it physically ships out the door, but somehow report a 36% jump in operating cash flow?
Yeah, it sounds completely counterintuitive.
Right, it really does. But today, we are tearing apart the Q2 fiscal 2026 earnings transcript of Mercury Systems to find out exactly how we're translating all that dense, jargon-heavy Wall Street language from their corporate earnings call into plain, actionable insights for you.
Exactly. And for those of you following along on your stock screeners at home, the ticker symbol is MRCY.
MRCY, yep.
And, Mercury Systems is just a really fascinating entity to dissect right now. They sit at this absolute critical intersection of hardware and software for the aerospace and defense sectors.
Which is a huge space right now.
Huge. I mean, they deliver mission critical processing at the edge.
Okay, so break that down for us. What does processing at the edge actually mean in practical terms?
Yeah, so in practical terms, that means the incredibly rugged, highly complex silicon and the software that goes into advanced radar, electronic warfare systems, missile defense.
So the really heavy-duty stuff.
Exactly. It is the heavy-duty computing power that modern defense systems completely rely on to function in extreme environments. You can't just put a regular computer chip in a fighter jet.
Right. It would just instantly fail.
Yeah.
Which makes this transcript a literal masterclass for anyone interested in defense technology or, honestly, manufacturing turnarounds. Or even just learning how to read between the lines of corporate financials.
Oh, absolutely. There's so much subtext in this call.
So here's our mission for this deep dive. We are going to look at the headline numbers, decode the underlying operational story driving those numbers, and analyze management's future guidance.
And then deliver a bottom line assessment.
Yes, the bottom line. If you hold this stock, or if you're considering a position, or simply want to understand how a defense contractor navigates a multi-year turnaround, there are a few very specific mechanical levers you really need to understand.
Yeah, concepts like backlog, margin dilution, and pull forward revenue.
Right, which sound complicated, but we'll break them down.
We will, because the overarching context here is a company in the middle of a massive operational shift. Mercury Systems is actively trying to dig itself out of older, structurally less profitable contracts.
While also, simultaneously positioning its factory floor and engineering teams for future growth.
Yeah, in a highly volatile global defense market, no less. And the numbers reported this quarter are the direct mathematical result of that friction.
So let's start by looking at the scoreboard from Q2, because on paper, the headline numbers look like an absolute blowout victory.
They really do.
Let's break down the bookings first, which is, it's the foundational metric of any manufacturing pipeline. Bookings for the quarter hit $288 million.
Which is massive.
Yeah, and that translates to a book-to-bill ratio of 1.23.
And that's a key number right there.
It is. Now, the way I look at a 1.23 book-to-bill ratio is that for every single dollar of finished product Mercury managed to ship out the loading dock and actually invoice to a customer, they had $1.23 in brand new orders coming right in the front door.
Right. It signals that demand is fundamentally outpacing their current delivery velocity.
Exactly.
And that ratio, that is the lifeblood of future revenue visibility. When a defense contractor sustains a book-to-bill over 1.0, they are actively expanding their pipeline.
And as a direct result of that specific $288 million intake, their total backlog, the aggregate value of all the orders they're legally contracted to build but just haven't delivered yet, that pushed to a record approaching $1.5 billion.
$1.5 billion.
Yeah, that's an increase of $119 million, or about 8.8% year over year.
Which is staggering. For a company of Mercury's market capitalization, having $1.5 billion locked in the backlog provides just this massive operational cushion.
Right. It really dictates how they can plan out everything, doesn't it?
It does. It dictates how they plan their labor force, their supply chain purchasing, their facility utilization for, honestly, the next several years.
It gives them the luxury of long-term planning, but then we transition to the actual recognized revenue, the money that officially crossed the finish line in Q2.
Right, the actual sales.
Revenue came in at $233 million, representing a 4.4% year-over-year growth, and adjusted earnings per share, or EPS, hit 16 cents.
Which is a massive leap from the 7 cents reported in the prior year.
It more than doubled. And even when we strip away the adjustments and look at the raw GAAP net loss-like, the unvarnished accounting reality, that metric improved as well. It moved from an $18 million loss a year ago to a $15 million loss, or 26 cents per share in this quarter.
But the profitability metric that really caught Wall Street's attention was the EBITDA.
Oh, yeah. Adjusted earnings before interest, taxes, depreciation, and amortization.
Exactly. Which analysts use as a proxy for the core operating cash flow generation of the business. That hit $30 million.
$30 million.
Yeah, representing a 12.9% margin. That marks an impressive 36.3% increase year over year.
Wait, they bolted on 300 basis points to their margin profile in a single 12-month cycle.
They did in 1 year. So if you are an algorithm scraping financial news feeds or just a retail investor skimming the top line, you see revenue up, EPS doubling, EBITDA surging over 30%, and a record backlog.
Yeah, the immediate assumption is that Mercury Systems is operating flawlessly.
Right. But the transcript reveals a massive, openly discussed caveat to these numbers.
The catch?
The catch. CEO Bill Ballhaus addressed it immediately. He detailed the concept of revenue acceleration, which Wall Street typically refers to as pull-forward revenue.
Ah, okay. The pull forward.
Yeah, they pulled forward $30 million in revenue that was originally scheduled, budgeted, and planned to be shipped in their fiscal third quarter, and they managed to accelerate the manufacturing process to deliver it in Q2 instead.
Wow. Okay, so the mechanical impact of that acceleration on the quarterly financials has to be profound. I mean, when you drag $30 million of top-line revenue from the future into the present, you drag the associated profitability right with it.
Exactly. You pull the revenue, you pull the profit. In this case, that pull forward brought approximately $10 million in adjusted EBITDA and $30 million in cash flow right along with it.
So when you're analyzing the health of the underlying business, you kind of have to mentally back those numbers out of Q2 to understand the true baseline operational win rate.
You absolutely do.
You know, I try to visualize this kind of pull forward using like a manufacturing production schedule analogy.
Okay, let's hear it.
Imagine a massive car factory. They have a strict quota to build 500 cars in Q2 and 500 cars in Q3. But midway through Q2, the factory floor realizes their supply chain is running incredibly smoothly, the workers are highly efficient, and they actually have the capacity to build 600 cars right now. So they build and ship those extra 100 cars early.
Making Q2 look amazing.
Exactly. The Q2 numbers look phenomenal. They beat their quota by 20%, but the structural reality is that unless new orders materialize instantly, they only have 400 cars left to build in Q3.
Because they consume tomorrow's backlog to satisfy today's output.
Right. It's like eating your Thursday dinner on Wednesday night. You feel incredibly full on Wednesday, but
you're going to be hungry on Thursday.
Exactly. So my question is, does that dynamic artificially inflate the perception of Q2's success?
Well, it undeniably alters the quarter-over-quarter growth narrative. But, and this is key, management is heavily messaging this not as some temporary distortion, but as a permanent return of operational muscle memory.
Oh, interesting.
Yeah. CEO Bill Ballhaus framed this acceleration as a major victory for their supply chain and manufacturing teams. The fact that they could physically find the parts, allocate the labor, test the systems, and get $30 million worth of highly complex electronics out the door ahead of schedule.
That's no small feat.
It's not. It is a testament to the factory floor returning to health. I mean, they achieved record first half revenue, the highest point in time revenue generation since fiscal year 21.
So the thesis here is that this isn't just some accounting gimmick where they recognize revenue early on a technicality. This is a physical logistical triumph. They built the gear and shipped the gear faster than anyone expected.
Precisely. The gear physically left the building and the customer accepted it early. That is crucial in defense contracting. However, you know, the investor still has to perform that mental calculus you alluded to with the car factory.
Right, the Q3 expectations.
Yeah, you cannot extrapolate Q2's growth rate in a straight line upward. The baseline expectation for Q3 must be mathematically lowered because that capacity was already absorbed.
Which we'll talk about when we get to the guidance. But the ability to accelerate that volume, to find efficiencies on the floor and push that extra 30 million out is directly tied to a massive internal restructuring at Mercury.
It is. The transcript breaks this down into 4 core priorities dictated by management: performance excellence, organic growth, expanding margins, and improving free cash flow.
Let's look at the organic growth priority first. They highlighted a few very specific wins that reveal where they see the future of aerospace. Like, they captured a major RF for radio frequency and processing subsystem win for an advanced air mobility manufacturer.
Right, and advanced air mobility is a pivotal dual-use market.
Dual use meaning military and commercial.
Exactly. This encompasses electric vertical takeoff and landing vehicles, often called eVTOLs, as well as next-generation autonomous drones and air taxis.
Oh, air taxis.
Yeah. By securing a processing subsystem win here, Mercury is basically ensuring their hardware is the central nervous system for platforms that could see explosive commercial and military adoption over the next decade.
That's a smart play. They also highlighted a new design win supporting a space-based application with a leading aerospace and defense prime contractor. Plus, they booked $20 million in follow-on awards utilizing anti-tamper and cybersecurity software from their recent Starlab acquisition.
That Starlab acquisition is fascinating.
I really want to linger on that anti-tamper aspect because I think it illustrates exactly what Mercury actually does. You know, when we talk about anti-tamper and defense electronics, we aren't talking about a simple password screen.
Not at all.
The Department of Defense mandates intense anti-tamper protocols so that if an American drone crashes in hostile territory, the adversaries cannot simply plug a laptop into the processor and reverse engineer the radar algorithms.
Right. The physical and software engineering required for that kind of anti-tamper is incredibly sophisticated.
Yeah.
It involves encryption at the silicon layer, self-erasing memory arrays if a casing is physically breached, and deeply embedded cryptographic keys.
Wow, self-erasing memory.
Yeah, it's intense. So by acquiring Starlab, Mercury brought a highly specialized niche capability in-house. That $20 million follow-on award demonstrates the strategic value of that acquisition perfectly.
Because once you are designed into a defense platform with your proprietary anti-tamper architecture, you become almost impossible to replace.
Exactly. The switching costs for the prime contractor would be astronomical.
Yeah.
They're locked in.
So these growth highlights are essentially Mercury planting seeds for highly defensible long-term revenue streams.
Yes.
But let's look at the other side of the ledger, the performance excellence priority, because this is where we run into the harsh reality of defense accounting.
Oh yeah, the EACs.
CFO Dave Farnsworth mentioned a critical metric. He said they reduced their net adverse EAC changes to just $4 million. Now, for anyone outside the aerospace industry, the term EAC sounds like standard bureaucratic jargon.
It does, but it is actually the mechanism that can bankrupt a defense contractor.
Okay, bring that down for us. What is an EAC?
EAC stands for Estimate at Completion. So the defense industry fundamentally operates on two types of contracts, cost plus and firm fixed price.
Okay.
In a cost plus contract, the government basically assumes the risk. If a project goes over budget, the government pays the difference, plus a guaranteed fee to the contractor.
Sounds like a pretty sweet deal for the contractor.
It was. But over the last decade, the Pentagon shifted heavily toward firm fixed-price development contracts. They did this to force contractors to bear the risk of innovation.
Meaning, okay, so Mercury bids, let's say, $50 million to invent a brand new ultra-compact radar processor. If it costs them $40 million to invent and build it, they make a massive $10 million profit.
Right.
But if supply chain issues or inflation or just unforeseen engineering hurdles push the actual cost to $70 million, Mercury has to eat that entire $20 million loss themselves.
Yes. And the accounting rules dictate that the moment a company realizes the total cost will exceed the contract value, they must immediately recognize that entire future loss on their current income statement.
Oh, wow. Immediately.
Immediately. That recognition is an adverse EAC adjustment. It is a violent, immediate hit to profitability.
So that's the bleeding.
That's the bleeding.
Yeah.
Over the past few years, as inflation spiked and supply chains seized up globally, defense contractors across the board, including Mercury, suffered massive EAC hemorrhaging because they were locked into these fixed-price development contracts that they signed in a low-inflation environment.
It's the ultimate deferred pain. They bid aggressively to win the work years ago, and the financial reality just finally caught up to them.
Exactly. But the key takeaway from this specific transcript is that the bleeding seems to be clotting.
Right, because to recognize only $4 million in net adverse EACs across a $1.5 billion backlog, I mean, that suggests the worst of those legacy contracts are nearly flushed out.
It does. Farnsworth, the CFO, was actually asked by an analyst what inning they were in regarding this cleanup. He responded by saying he was a track guy, not a baseball guy, but they're on the last leg of the relay race.
The last leg.
Yeah. And that phrasing is a deliberate signal to institutional investors. The market has severely discounted Mercury stock over the past 2 years, entirely due to the unpredictability of these EAC hits.
So when the CFO publicly declares they are on the last leg of the race, he is asserting that the risk profile of the backlog has fundamentally stabilized.
Yes. The engineering teams have finally gotten their arms around the true cost of completing these legacy development programs.
But stabilizing those costs requires cutting overhead, which leads us to a major structural question raised in the transcript. Mercury successfully drove down their operating expenses, but the composition of those cuts is, well, it's fascinating.
It's definitely a choice.
Research and development costs decreased by 28%. That is a massive drop of $6 million year over year, driven largely by headcount reductions initiated in the previous fiscal year.
Right.
Concurrently, restructuring charges increased by $4 million in Q2 as they executed layoffs affecting roughly 100 employees.
Now, I look at a 28% cut to R&D for a tech-heavy defense company, and I see red flags everywhere. It sounds alarming.
Right. Their entire competitive moat is supposedly their ability to deliver cutting-edge processing speed and miniaturization. How can a company slash R&D by nearly a third without fundamentally crippling their future innovation pipeline?
Well, the bull argument, which management obviously leans into, is that this is not cutting into the bone of innovation, but rather eliminating profound historical bloat.
Bloat? Where did the bloat come from?
Acquisitions. Mercury Systems spent years aggressively acquiring smaller defense electronics firms. When you acquire a dozen different companies, you inherit a dozen different R&D labs, all pursuing overlapping technologies with completely redundant engineering staff.
I see.
So the 28% reduction is presented as a rationalization of those efforts.
They are trying to consolidate the scattered engineering teams into a single focused directive.
Yes, and the transcript points directly to what that focused directive is.
Yeah.
The Common Processing Architecture, or CPA.
CPA management discussed CPA repeatedly as the cornerstone of their future manufacturing strategy. They are actively adding 50,000 square feet of highly automated factory space in Phoenix, dedicated exclusively to these CPA programs.
And this shift to the Common Processing Architecture is an attempt to change their fundamental business model.
How so?
Historically, defense electronics has been a bespoke, custom engineering business. A prime contractor asks for a radar processor, and the subcontractor builds a highly customized, completely unique piece of hardware specifically for that one aircraft.
Which sounds slow and expensive.
It is slow, it's expensive, and it's incredibly difficult to scale. CPA is an initiative to create a standardized, modular baseline of hardware and software. Instead of inventing a new processor from scratch every single time, they take an 80% complete standardized CPA module and only customize the final 20% for this specific platform.
Okay, so it's the difference between hiring a tailor to hand-stitch a custom suit from scratch versus buying a high-end, off-the-rack suit and just getting the cuffs hemmed.
That's a great analogy. Yes. The off-the-rack approach allows you to build the core product in massive, automated batches, achieving real economies of scale.
And this transition to automated, scalable manufacturing introduces a staggering data point regarding their future leverage. Bill Ballhaus noted that currently they are primarily running single shifts in their factories.
Yeah, the operational leverage embedded in that single sentence is immense.
Because when a manufacturing facility operates on a single daytime shift, the capital equipment, the automated soldering machines, the environmental testing chambers, the assembly lines, they just sit idle for 16 hours a day.
Right, they're doing nothing all night.
So if geopolitical tensions require the Department of Defense to radically increase procurement of electronic warfare systems tomorrow, Mercury does not need to endure a 2-year, multi-million-dollar capital expenditure cycle to build a whole new factory.
Nope. They simply hire a second shift, they turn the lights on at night, and they double their throughput using the exact same physical footprint.
And their fixed facility costs remain virtually flat while their revenue doubles, leading to massive margin expansion.
And that ability to scale without heavy capital expenditure is the absolute holy grail for an industrial turnaround.
Right.
However, your initial concern regarding the R&D cut remains the central tension of this entire story.
Right, because the balance sheet is undoubtedly healthier today because they laid off those engineers and reduced spending.
But in defense technology, the product cycles are measured in decades.
Decades, yeah.
The R&D investments made today become the deployed systems of the 2030s. The market is basically forced to trust that management correctly identified which legacy R&D projects were truly redundant and which were the vital seeds of future platforms.
And if they miscalculated, the consequences won't be visible in the earnings reports for another 5 years.
Exactly. You won't know until it's too late.
So this tension between cutting costs today and funding tomorrow perfectly sets up the most mathematically counterintuitive section of the entire earnings call.
The margin.
The margins. I want to lay out the raw numbers from the transcript because they initially appear completely contradictory.
They really do.
In Q2, Mercury's gross margin actually decreased by 130 basis points year over year, landing at 26%. So the raw profitability of the physical goods they sold went down.
Right.
And yet, because operating expenses decreased, their adjusted EBITDA margin, the bottom line operating cash flow, actually increased by 300 basis points to 12.9%.
It is the ultimate accounting paradox. The company is generating less profit on the direct assembly of the widgets, but somehow retaining significantly more cash at the corporate level.
You know, I try to model this using a different industry to make it intuitive. Let's go back to cars. Imagine a legacy automotive company that is legally bound by old contracts to manufacture 10,000 specific, outdated sedans for a massive rental car fleet.
Okay, but
Because of inflation on steel and labor over the last 3 years, the direct cost to build these sedans has skyrocketed, but the contract price is completely fixed. So the gross margin on every sedan rolling off the line is abysmal. It is just dragging down the factory's overall profitability metrics.
the raw cost of goods sold is just devouring the top-line revenue.
Precisely. However, while the factory floor is struggling with these highly unprofitable sedans, the CEO executes a massive corporate restructuring. They close 3 redundant regional headquarters, they lay off hundreds of middle managers, they slash the marketing budget, and they consolidate their IT infrastructure.
So they radically lower the operating expenses required to keep the overall corporate entity alive.
Right. So even though the factory is making a tiny squeezed margin on those legacy sedans, that small gross profit no longer has to support a bloated corporate superstructure. The overhead is gone. Therefore, a much larger percentage of that tiny gross profit flows completely unimpeded directly into the corporate bank account as EBITDA.
That analogy perfectly isolates the mechanics of Mercury's current quarter. In defense industry terms, management refers to those unprofitable legacy sedans as the lower margin backlog.
A lower margin backlog.
Right. Mercury has a $1.5 billion warehouse of promised work. Inside that backlog are programs they bid on years ago with terrible pricing structures.
Just structurally bad contracts.
Yes. And they're legally mandated to fulfill those contracts. They cannot simply walk away and abandon the work. As they physically build and ship these legacy systems, they recognize the revenue, but the associated gross margin is painfully low.
And we can see the sheer power of their reduced corporate overhead when we analyze the flow-through rate of the revenue they managed to accelerate.
The $30 million.
Right. They pull forward $30 million in revenue into Q2. Because the corporate overhead, the SG&A, the R&D was already largely covered by their baseline operations, that incremental $30 million fell through the income statement with incredible efficiency. It generated $10 million in adjusted EBITDA.
And the mathematics there are striking. $10 million in profit generated from $30 million incremental revenue represents a 33% flow-through rate.
33 cents on the dollar.
Yeah. In the realm of complex electronics manufacturing, dropping 33 cents of every incremental dollar straight to the bottom line proves that the core restructured operating model is inherently highly profitable once volume is actually pushed through it.
But the shadow of that lower margin backlog is still dictating the narrative. During the Q&A session, analyst Peter Arment from Baird asked a very direct question regarding the timeline of this margin compression.
Right, the how long is this going to last question.
He wanted to know how long this low margin backlog will continue to drag down the gross margins. And CEO Bill Ballhaus was transparent, admitting that this lower margin backlog will persist through the remainder of fiscal year 2026 and will likely continue to impact financials well into fiscal year 2027.
Which is a long time.
It is. If I am an institutional investor allocating capital, why should I lock my money up in a stock that management admits will be burdened by structurally bad contracts for another 18 to 24 months?
Well, the counter-argument relies on the mathematical certainty of the backlog churn.
Okay, explain that.
It is true that the ship is turning slowly, but the trajectory of that turn is mathematically locked in by the new bookings. Every single quarter, Mercury physically manufactures and ships a portion of those legacy low-margin contracts.
Right.
Once shipped, those terrible contracts are purged from the backlog forever.
So they are burning the bad wood.
They're burning the bad wood. And crucially, they were replacing that bad wood with the new bookings. That $288 million they booked this quarter, the orders driving that 1.23 book-to-bill ratio, those contracts were negotiated and priced in the current post-inflation environment.
So they have better margins.
Much better. Bullhouse explicitly stated on the call that the new bookings are entering the backlog at their target margin profile. They're utilizing disciplined pricing models now.
So the backlog is essentially like a massive chemical solution. Right now, it is polluted with these low-margin legacy contracts. But every quarter, they drain out a gallon of the polluted water and pour in a gallon of pure, high-margin new orders.
Exactly.
You might not notice the difference week to week, but over an 18 to 24-month timeline, the concentration of the entire tank fundamentally changes.
Yes. The margin expansion isn't reliant on some sudden, miraculous leap in operational efficiency. It is driven by the steady, inevitable replacement cycle of the underlying contracts.
Which is a pretty compelling thesis for a long-term value investor.
It is. However, while investors wait for that 24-month mathematical progression to play out on the income statement, the company still has to manage its daily liquidity.
Right. You can fake earnings with accounting tricks, but you can't fake cash in the bank.
Absolutely. The ultimate arbiter of a successful corporate turnaround is not adjusted earnings, but cash.
And the cash flow metrics generated in Q2 were remarkably robust, providing a crucial lifeline while the backlog slowly purges. Free cash flow was a positive inflow of $46 million.
Just solid.
Very solid. They immediately deployed that cash to de-risk the balance sheet, driving net debt down to $257 million, which is the lowest debt burden the company has carried since the first quarter of fiscal year 22.
Wow.
But the most intriguing metric on the balance sheet is the net working capital, which came in at $414 million. That represents a $61 million reduction year over year.
$61 million.
Yes. And to understand how they squeezed $61 million of trapped cash out of their daily operations, we really have to look at an operational tactic focused entirely on something called unbilled receivables.
And this strategic focus on unbilled receivables is perhaps the most revealing detail about the granular realities of defense manufacturing in the current era.
Okay, so define the term for us. What exactly is an unbilled receivable?
Okay, imagine Mercury is contracted to build a multi-million-dollar, highly complex radar processing unit for a naval destroyer. Over the course of 9 months, they procure the chassis, they assemble the circuit boards, load the proprietary anti-tamper software, and conduct initial environmental testing. The unit is 99% complete.
Okay.
The company has expended massive amounts of cash paying the engineers, the assembly technicians, and all the component suppliers to get the product to this stage.
But because of some supply chain hiccup, they are missing one specific, highly specialized microchip required for the final power sequence.
Right, so the physical unit is just sitting on a rack on the factory floor. Because it is not 100% complete and cannot be formally accepted by the Navy, Mercury cannot issue the final invoice.
Oh.
They cannot legally bill the customer for the millions of dollars of labor and materials already embedded in that physical box. That trapped, illiquid capital is an unbilled receivable.
It is the equivalent of building a custom house, finishing the foundation, the framing, the plumbing, and the roof. But because the front door hasn't been delivered yet, the bank refuses to release the final construction funds.
That's exactly it.
Your cash is entirely trapped in the drywall and 2x4s until that door finally arrives. And Mercury apparently had a mountain of these nearly finished systems just clogging up their factory floor and their balance sheet.
They did. And the tactical shift management announced on the call was aggressive. They explicitly stated they are deliberately allocating factory capacity, meaning physical floor space, testing equipment, and highly skilled engineering labor, specifically to programs that carry large unbilled receivable balances.
Wow. The strategic implication of that decision is profound. They are taking their most valuable resource, their manufacturing labor, and intentionally pulling it away from starting new projects that could generate new top-line revenue growth.
Yeah.
Instead, they're forcing the factory to hyper-focus purely on finishing the 99% complete legacy units just so they can finally install that missing microchip, close the chassis, send the invoice, and unlock the trapped cash.
Exactly. They are openly sacrificing the vanity metric of top-line revenue growth in exchange for raw cash conversion.
It is a textbook liquidity maneuver for a turnaround. But it inevitably creates severe friction with Wall Street analysts, right? Whose financial models are structurally biased toward continuous top-line expansion.
Absolutely. Analyst Michael Tramley from Truist Press Management on this exact issue during the Q&A. He highlighted that Mercury's top-line revenue growth is undeniably sluggish, lagging behind both its small to mid-cap defense peers and, in some cases, the growth rates of its own prime contractor customers.
So Tramley recognized the trade-off.
Yeah.
He basically asked, by dedicating your factory floor to clearing unbilled receivables, are you functionally creating a self-inflicted drag on your own revenue growth?
And CFO Dave Farnsworth's response was remarkably candid for a corporate executive. He didn't attempt to spin the narrative or deny the trade-off.
What did he say?
He acknowledged that dedicating resources to working capital burn down absolutely creates a drag on new revenue generation.
Well, just admitted it.
Just admitted it. But he firmly reiterated that the unbilled balances were still unacceptably high, and unlocking that trapped cash to pay down debt remained the overriding corporate priority.
And this candid admission naturally leads to an exploration of the root cause. Why did Mercury end up with so many 99% complete systems sitting idle on the factory floor in the first place?
The answer lies in the systemic, ongoing fragility of the global aerospace supply chain. During the call, CEO Bill Ballhaus provided a remarkably vivid, granular look into the logistical nightmares facing defense manufacturers today.
Yeah, an analyst asked if there were specific categories of components like semiconductors or specialized printed circuit boards that were creating these bottlenecks.
And Ballhaus responded by describing a reality where executives are literally reviewing bills of material line by line every single week across every major program.
Every single week. Now, a bill of material is essentially the master architectural recipe for a defense system. It lists every single screw, resistor, and specialized microchip required for assembly.
Right. And in commercial manufacturing, say, building a consumer laptop, if a specific capacitor is unavailable, the manufacturer can often substitute a widely available commercial equivalent from a different supplier with minimal disruption.
Sure, just swap it out.
But aerospace and defense manufacturing is governed by rigid military specifications, or mil-spec. Components must be certified for radiation hardening, extreme temperature tolerances, and rigorous anti-counterfeit traceability.
So if a specific mil-spec chip is delayed, you cannot simply buy a substitute on the open market.
Nope. The entire multi-million-dollar assembly just halts.
And Ballhaus described the maddening unpredictability of managing these suppliers. He detailed scenarios where Mercury's procurement team is aggressively tracking a critical component. On a Tuesday, the supplier guarantees a part will arrive on Friday.
Right. So the factory floor schedules the assembly technicians and preps the testing chambers for a Friday afternoon integration.
And then Friday morning arrives, the phone rings, and the supplier casually informs them that the part is now delayed by 60 days.
A 60-day delay announced on the morning of expected delivery destroys any attempt at efficient factory scheduling. It leaves highly paid technicians standing idle, and it traps millions of dollars in unbilled receivables for another 2 months.
That raw systemic unpredictability is the defining constraint of their current operational model.
It really is.
And understanding that deep-seated trauma regarding the supply chain provides the absolute necessary context for understanding the final section of our dive, the bottom line and future guidance.
Yes, the guidance.
Because the tension regarding guidance was the most palpable aspect of the entire earnings call. Despite the massive revenue beat in Q2, the record backlog, and the expanding EBITDA margins, management stubbornly maintained their full-year fiscal year 26 guidance of merely low single-digit revenue growth.
Which, in the context of a defense budget that has seen significant recent expansion, is an incredibly conservative, almost anemic growth projection.
And furthermore, because they successfully pulled that $30 million of revenue forward into Q2, they explicitly guided that Q3 revenue is expected to be down year over year.
The Thursday dinner was eaten on Wednesday night, and now they were forecasting the Thursday hunger.
Exactly. They did provide some margin optimism, expecting Q3 adjusted EBITDA margins to approach double digits, and reiterating that Q4 will historically be the highest margin quarter of the fiscal year due to standard government budget cycles.
Or the Q4 flush.
They also highlighted massive potential macroeconomic tailwinds. They noted that international defense markets currently represent about $38 million, or roughly 16% of Q2 revenue, providing geographical diversification. And they repeatedly referenced their positioning for domestic initiatives like the Golden Dome.
And the Golden Dome initiative represents a potentially transformative shift in defense procurement.
Tell us about that.
It is a broad, strategic push to radically upgrade and integrate domestic air and missile defense capabilities. This is largely driven by the proliferation of cheap, asymmetric drone warfare and advanced cruise missiles seen in recent global conflicts.
So for a company like Mercury that specializes in the exact radar processing and electronic warfare components required for air defense, a fully funded Golden Dome initiative represents a massive multi-year addressable market.
It's huge for them.
So you have a company that beat expectations in Q1, crushed expectations in Q2, boasts a record $1.5 billion backlog, and sits directly in the path of massive potential defense tailwinds like Golden Dome. And yet, management absolutely refused to raise their full-year guidance.
Yeah, they wouldn't budge.
This refusal drove the Wall Street analysts to a point of visible frustration. Analyst Ken Herbert from RBC pushed back hard, essentially asking, "You have established a clear pattern of beating estimates and pulling revenue to the left. Your pipeline is full. Why are you continuing to anchor the full-year guidance so low?"
And the answer is entirely rooted in that Friday morning phone call from the delayed supplier. Ballhaus calmly explained that their ability to accelerate revenue and beat quarterly expectations is 100% dependent on the physical availability of materials. Because the supply chain remains fundamentally untrustworthy, management refuses to bake future theoretical accelerations into their public guidance.
Ballhaus actually stated, "I don't want to give commentary and set expectations based on things that we don't have 100% confidence around." He is drawing a hard line in the sand.
He is. He will not promise Wall Street a higher revenue number based on components that are not physically sitting inside a Mercury Systems warehouse.
In an era where corporate executives routinely overpromise based on optimistic projections, this level of grounded, almost pessimistic conservatism is striking.
It is the defining characteristic of a management team that has survived the worst of a turnaround. They prioritize operational discipline and credibility over short-term stock price manipulation.
Right.
They prefer to establish a low bar and systematically vault over it rather than risk a catastrophic miss due to a single delayed microchip.
So as we synthesize this massive influx of data from EAC adjustments and margin dilution to unbilled receivables and supply chain paranoia, we must deliver a bottom-line assessment. Is the trajectory of Mercury Systems fundamentally bullish or bearish?
Well, the underlying data in this transcript is complex enough to vigorously support both cases.
Okay, let's outline the bull case first. The argument that Mercury is significantly undervalued and poised for a breakout.
The bull case is anchored in mathematical inevitability and massive operational leverage.
Right.
The company's backlog is sitting at a record $1.5 billion, providing multi-year visibility. The toxic, poorly priced legacy development contracts that decimated their profitability over the last 2 years are finally in the last leg of the relay race.
As those bad contracts naturally burn off, they are being replaced by $288 million in new bookings priced for the current economic reality.
Exactly. Furthermore, management has proven they can ruthlessly extract cash from the balance sheet, dropping net debt to multi-year lows and generating $46 million in free cash flow.
But the ultimate catalyst in the bull case is the factory floor. By consolidating their R&D into the common processing architecture and running their highly automated facilities on a single shift, they have created a coiled spring.
If the Department of Defense accelerates procurement for initiatives like Golden Dome, Mercury can instantly scale production by just adding a second shift.
And because they have already slashed their corporate overhead, a massive percentage of that new top-line revenue will drop straight to the EBIT line. The conservative guidance is simply smart management purposefully sandbagging to guarantee future earnings beats.
So that's the bull case. It's a compelling narrative of a lean, de-risked machine ready to scale.
But the bear case is equally grounded in the transcript's stark realities.
It is.
The bear case argues that investors must strip away the accounting mirages and look at the core growth engine. Top-line organic growth is undeniably sluggish, trapped in the low single digits and actively trailing both competitors and customers.
Right, and their entire ability to execute on their backlog is held hostage by a deeply fragile supply chain, where a single missing $50 component can completely derail a quarter's cash flow.
The promise of future margin expansion is alluring, but the CEO openly admitted the gross margin drag from bad contracts will persist for at least another 18 to 24 months.
2 years is an eternity to hold a stock, waiting for a turnaround to mathematically finalize.
And most critically, to achieve these immediate EBITDA beats, management just laid off another 100 people and slashed research and development by nearly 30%. The bears argue that in the hyper-competitive, deeply technical world of aerospace processing, you simply cannot cut your way to sustainable long-term growth.
Yeah, the investor really must weigh whether the operational discipline demonstrated by management is a permanent foundation for scalable growth or simply a defensive posture masking a fundamental lack of market-taking innovation.
We have taken an incredibly deep journey into the mechanics of defense manufacturing today. We started with a headline revenue beat that looked flawless, only to uncover the $30 million pull forward that fed today by starving tomorrow.
Right. We explored the brutal reality of fixed-price contracts and adverse EACs, discovering how a company can generate less gross profit on the physical hardware, but engineer higher EBITDA margins by ruthlessly cutting corporate overhead.
And we followed the trapped cash down to the factory floor, analyzing how 99% finished systems waiting on a single delayed microchip force management to abandon growth metrics in favor of unbilled receivable conversion.
The transcript really reveals the sheer friction of executing a turnaround in an industry governed by mil-spec requirements and geopolitical volatility.
It requires looking far past the polished press release. But as we conclude, I want to leave you with a final provocative operational question to ponder on your own.
Okay, what is it?
Mercury Systems has undeniably proven over these last few quarters that they can execute the defensive plays of a turnaround playbook. They can optimize the factory floor, they can stop the bleeding on legacy contracts, and they can squeeze trapped cash out of old inventory. They are building a highly efficient, lean manufacturing engine.
Definitely.
But here's the critical question. Once the low-margin backlog is completely purged and the factory is perfectly optimized and all the unbilled receivables are collected and converted to cash, where will the brand new explosive organic growth actually originate?
That's the million-dollar question.
If you have slashed your research and development budget by 28% today to protect your current margins, are you secretly mortgaging the vital technological breakthroughs you will desperately need to win the next generation of fixed-price development contracts 5 years from now? Can a complex technology company truly survive the future by exclusively optimizing the present?
That tension between present survival and future relevance is the ultimate defining test of any corporate turnaround.
It really is the core dynamic to monitor as you watch how this specific stock and the broader defense technology sector navigates the realities of the next fiscal year. Thank you for joining us on this deep dive into the underlying mechanics of Mercury Systems. Keep questioning the headline numbers, keep looking for the mechanical realities driving the margins, and we will see you next time.